Imagine a generation promised that education was the golden ticket to the middle class, only to realize, upon crossing the university threshold, that they are shackled to an invisible chain worth tens of billions of dollars. In Canada, student debt is no longer just a line item on an individual's balance sheet. It has evolved into a silent economic force of destruction. Total federal student debt has surged past the $23 billion mark, excluding provincial loans. In the shadows of skyscrapers in Toronto and Vancouver, a time bomb is ticking. As the Bank of Canada BARC maintains high interest rates to curb inflation, the cost of capital for these young Canadians has skyrocketed, suffocating consumption and freezing liquidity in the real economy. This is not merely a story of struggling graduates. It is a systemic crisis where excessive financial leverage threatens housing market stability and national credit ratings. Is Canada following the path of historical sovereign debt crises, or are we witnessing a new variant of financial collapse called the academic dream? We are about to peel back the layers of this detonator. The signs of a financial crisis rarely begin with a loud bang, but rather with the gradual erosion of credit indicators. In Canada, the household debt to disposable income ratio has hit record highs within the G7, and student debt is the most dangerous gray zone in this structure. Look at the balance sheet of a recent graduate. Entry-level salaries are failing to keep pace with CPI growth, while rising real interest rates transform variable loans into unmanageable burdens. This drop in personal liquidity triggers a domino effect. The youth are delaying home purchases, marriage, and childbirth. When a vital segment of the labor force loses its ability to accumulate assets, the flow of capital in the economy stagnates. Delinquency rates in Canada are beginning to creep upward, mirroring patterns seen before major financial meltdowns. These numbers do not lie. They are warning signals of a structural imbalance where the value of a degree is being inflated, while the actual debt becomes a form of black credit legitimized by financial institutions. The mechanics of a debt-driven economic shock follow a ruthless script, the liquidity trap. When the policy rate is pushed higher to combat inflation, the debt servicing cost increases exponentially. For Canadian student debt, a large portion consists of floating rates or those directly linked to the central bank's discount rate. As the BARC engages in quantitative tightening, cash flow intended for consumer spending is diverted to bank interest. This creates a local deflationary spiral. Demand drops, businesses cut staff, and the income of young people falls further, making debt repayment virtually impossible. This phenomena is similar to the mechanism of credit default swaps, CDS, during the 2008 crisis, but here, the underlying asset is human potential. If student debt is reclassified as a high-risk asset, commercial banks will tighten other lending conditions, triggering a credit crunch across the system and turning an educational issue into a national financial tremor. To grasp the gravity of the situation, look into the mirror of history and global economies. In 1997, the Asian financial crisis erupted when the IMF had to intervene in nations with excessive financial leverage. In Greece or Argentina, public and private debt exceeded GDP capacity, leading to banking collapses and hyperinflation. Canada has not yet fallen into the default status of Venezuela or Turkey, where currency devaluation makes all debt infinite. But our student debt structure bears a haunting resemblance to the US subprime mortgage crisis of 2008. The only difference: student debt in Canada cannot be easily discharged through bankruptcy like credit card debt. It is a perpetual debt. while Iceland chose to cancel household debt to save its economy after 2008. Canada is choosing the opposite, maintaining the debt pressure. Lessons from these nations show that when a debt block exceeds 10% of GDP or dominates household debt, without collateral, a minor shock in foreign exchange or interest rates is enough to trigger a massive capital flight. The most direct impact of student debt on the Canadian economy lies in the real estate market, the backbone of the national GDP. A generation trapped in debt means real demand for housing is being neutralized. As bank stress tests become more stringent, those with significant student loans are effectively disqualified from the mortgage market. This creates a paradox. Home prices remain high due to speculation, but liquidity from first-time buyers is vanishing. Without fresh blood from the younger generation, the Canadian housing bubble loses its natural support and risks a violent burst. Furthermore, debt pressure diminishes labor, productivity, and innovation. Instead of taking the risk of starting a business, young people opt for stable but lower-paying jobs just to cover monthly interest. This is internal brain drain, where economic potential is strangled by financial barriers. Canada is trading future GDP growth for short-term debt. Recovery Strategy economists call eating the seed corn of the nation. The response from the Canadian government and the central bank has, so far, been more patchwork than a fundamental cure. Eliminating interest on federal student loans was a positive step, but it is merely a painkiller for an infected wound. Central banks are caught in a pincer movement. On one side, the need to keep rates high to protect the CAD and curb inflation. On the other, the risk of collapsing the household debt system. Current support policies focus primarily on extending repayment terms, which effectively pushes the burden further into the future. If the BOC does not provide a roadmap for rate cuts, or if the government fails to implement a debt-to-public investment conversion program, the economy will soon face liquidity freezing. We must also look at the role of Canada's Big Five. Commercial banks. They hold this debt as assets on their books, and any decline in value will affect the national financial system's credit rating on the international market. In a volatile macroeconomic climate, an individual survival strategy requires sharp economic intuition. Borrowers must understand opportunity cost. Rather than trying to pay off all debt as quickly as possible during high inflation, restructuring debt portfolios and utilizing government repayment assistance plans (RAP) is essential. This is a time to prioritize liquidity over hard asset accumulation. In an economy with fluctuating rates, maintaining an emergency fund equivalent to 6 months of living expenses is more critical than paying down an extra few $1,000s of principal. The practical insight here: do not let student debt ruin your credit score, as it is the only key to accessing cheaper financial leverage in the future when the economic cycle shifts. Treat student debt as a variable in your monthly cash flow equation rather than a psychological burden. Sobriety in personal financial management not only saves your own future, but serves as the final shield preventing the collapse of the household economic system against global market turbulence. Zooming out, Canadian student debt is part of a larger picture of generational inequality. Looking at the Gini index and social mobility, we see an alarming stagnation. The wealthy, who can pay tuition in cash, hold an absolute advantage, while the poor must borrow to work, then use their wages to pay interest back to the wealthy via the banking system. This is a reverse redistribution mechanism, widening the wealth gap. Economics calls this a middle-income trap within a developed nation. Without a systemic shift in how we approach education and finance, Canada risks losing its status as one of the world's most livable countries. This time bomb doesn't just threaten individual wallets, it threatens the stable social fabric that is the pride of the Maple Leaf Nation, turning it into a fragmented and high-risk market for international investors. The final message we must realize is the urgency of comprehensive financial reform. Student debt should not be viewed as a mere personal investment, but as the intellectual infrastructure of the nation. When a country builds a highway with debt, they expect commerce to offset the cost. When a country builds knowledge with debt, they must ensure that knowledge generates an economic surplus sufficient to service that debt. Currently, the mismatch between education and the labor market is driving the return on investment ROI of higher education in Canada to record lows. We need new models like income share agreements, ISAs, or stronger corporate participation in training subsidies. This debt bomb can only be diffused if we stop treating education as a pure commodity and start seeing it as a strategic asset that must be protected from toxic interest rate volatility. The sustainability of the Canadian economy depends on liberating the youth from financial shackles so they can freely innovate and consume. We have journeyed through the darkest corners of the $23 billion student debt figure. From pressures on the national balance sheet to the individual deadlocks in the real estate market, Canada stands at a historic crossroads. Either bravely execute a large-scale debt restructuring to unleash the people's potential, or continue to turn a blind eye as this bomb detonates over the next decade. But ultimately, debt is not just money. Debt is a promise about the future. When a generation no longer believes in that promise, do currency value and social stability still hold meaning? Are we witnessing the end of the era of degree-based prosperity, or is this merely a ruthless test of the laws of supply and demand in modern economics? Finally, if you are a student carrying a $50,000 debt, will you choose to keep playing by the old rules, or will you be the one to spark a shift? In your own economic thinking, one big question remains. In an economy built on debt, who truly owns your future?